All right. So tonight we're going to do a couple things. I want to go over some of the problems with the Blackboard app. I haven't really had a problem too much in this class, but it's my other class I have, so I'm kind of going over it in every class because it's not just for this class; it's for other classes too. And then we'll start out on the Chapter 10 handout, and we'll also continue with the monetary unit sampling. One warning about the Chapter 10 handout, I sent out a new one this week. It actually has a page added to it. Now, if you already printed it out, don't worry. If you already printed it out, just print page 9. So if you already have it printed out, there's no problem. Page 9 is the new one. Again, you know, it's one page different than the one last week. So anyway, yeah, so those are due. So let's first go into this Blackboard app problem. And Blackboard app problem, there's actually 2 problems that have been noted that has been happening. And so I'm going to go over both of them. The first one I don't think happens that often. Do not use the save as draft while submitting an assignment. And if you hit save as draft, what that means is you want to look at it before you submit it. Now, the problem is it's going to look like you've already submitted it. You'll see a message that looks like this. This assignment is complete. Review the submission history. The assignment is complete, but it hasn't been submitted. So this assignment is complete does not mean it's been submitted. This means that you've got a file there for the assignment. So, you know, it's misleading because then you go back in, you think, oh, everything must be fine. Look, it says this assignment is complete. Why is my teacher telling me he doesn't, you know, she doesn't have it? So that's the save as draft problem. Now, there's another file that I'll pull up in a second here that'll tell what to do if you have that. Actually, I'll pull it up right now. There's another file that's it's called Blackboard pending assignment. Okay, so if you submit the assignment and you do save as draft, this is what I see. I see a little blue circle thing, and there's nothing I can do with that. It says it's pending, and it's basically what it's there for is if someone was doing a test or something, and you know they have an hour to do it, and they were still working on it, it would show that pending. The problem is it doesn't go away, and I can't get rid of it. So there's a pending problem. Now, if you do have that, let's say you put save as a draft, and you know, so well, what if I did that? Okay, what you have to do is go back in and hit continue. You're going to hit continue that, and once you hit continue, then you can go down and hit submit. So click on the assignment itself, and again, it's going to look like it's done, but it's not. You have to hit continue and then submit. So it's misleading in that it looks like it's done, but it's not. Okay, now this next one I think is the one that we're having more problems with, and that is the document must be closed before it can be submitted. And I think that this is and the reason that I think this is coming up, I think, is because the people using the app on the phone, I don't think it's actually the app on the phone that's the problem. Is not closing the document, because if your phone is like my phone, it's kind of hard to know what's even open. And I think that's what's happening. I think people have a document open on the phone and they submit it, and Blackboard doesn't like that. Blackboard says, okay, this isn't done. And I get the same pending thing we had before. So you have to close the document before you submit it. And that's not just this class, that's every class. And both of these are for every class. So just be careful of that. So 2 things, if you can avoid it at all, don't hit the save as draft. In this class, you definitely don't, because even if you submit the wrong thing, you can always submit the right thing. There's unlimited submittals. You know, if you put the wrong thing in or you want to change it, you change load it again, that's fine. So you definitely don't need it in this class. Any other classes, if you have a time test, you may use that. But anyway, so don't use the save as draft. And then also make sure that you close your documents before submitting them, because if you don't, there's a really good chance that it's not going to be able to be read in Blackboard. And I think I should just say before, if I didn't, also I should put two other things in here. Blackboard. That's not how I spell it either. I'm just showing you different ways of not spelling Blackboard. Okay, in Blackboard, cannot read the Apple page files or the Windows zip files. Now, if you have an Apple, you can convert it into PDF. You might be able to do that too if you have an Android or a Windows type of a program. But you can convert it to PDF. And PDF, Blackboard can read PDF fine. So if you convert these into PDFs, that's fine. You can also, a lot of times what you're zipping is actually the pictures of your work. So if you just submit the pictures, that's another way to do it. Can you guys hear me okay?
Yeah.
Okay, all right. And I was looking at the monitor on my microphone. It doesn't look like it's registering very much. Okay, yeah, so there's a few things. I mean, and again, you know, Blackboard is what we got. There's other programs out there. Every program like Blackboard is quirky. I've worked with Canvas, it's quirky. I don't know. But anyway, so just keep those things in mind when you're working on it. Okay. So let's go to cache. And the audit of cache. The audit of cache is extremely important. Well, let me make this stuff up. Oops. Okay, the cash account, the balance in the cash account may be very low compared to the other accounts, but it's very important to the audit. Okay, the cash account a lot of times is fairly small. You know, you may have 10 million in cash, but you have 60 million in inventory and 30 million in equipment and 110 million. You know, the cash account, you look at the balance and you go, okay, that's fairly small. I mean, sometimes it's immaterial. You know, sometimes it's small enough that the cash account you look at it as, well, it's not material. However, virtually everything runs through cash. It's almost hard to figure out as a situation where it doesn't run through cash. So nearly every transaction runs through cash. Oops. Nearly every transaction runs through cash. So, I mean, again, it's almost hard to think of a transaction that doesn't. Someone trading land for stock or something like that. I mean, it's almost difficult to think about a transaction not running through cash, because even if they traded, land for merchandise, the merchandise was going to run through cash at some point, through accounts payable, or maybe even just paid cash for it in the first place. So it's really hard to come up with a transaction that never runs through cash. So almost everything runs through cash at some point. And even if you get a loan, you buy a $10,000 truck and you get a loan for $10,000, you say, hey, there's no cash there. And there isn't, but you pay the loan with cash, you pay the interest with cash. There's all kinds of evidence about the loan and interest going through cash. So almost every transaction runs through cash. And that's why it's so important, because while you're proving cash, you're really proving all the stuff that runs into it. You're proving revenues, expenses, certainly accounts receivable, accounts payable. So a lot of the stuff comes through it. So, my period. The accounts, the usual accounts you're gonna see that running through there are revenues. So a lot of times when you're proving cash, you're proving revenues, expenses. Dividends, they run into the equity section. Like I say, it's always hard to find an account that doesn't run through those things. And through the accounts receivable and through the accounts payable, you run into the inventory accounts, cost of goods sold, calculations. All that stuff, it all runs through there, and those are really big things, especially the revenues and expenses. For most companies, the biggest part of the audit is figuring out the income. Not that the other stuff's not important, but a lot of times the income is really the main focus of an audit. So proving out the revenues and expenses, even if they run through accounts receivable, accounts payable, it's big. So we audit cash is fairly serious. I'm going to label this as 1. All right. Oops. Okay. Second thing about cash. Cash is valuable to everyone. So among the assets, it's probably the most desirable for someone to take, right? I mean, people steal all their things, people steal inventory and that sort of thing. Generally not. I mean, generally, I shouldn't say generally not. Generally, it's generally not is immediately available as cash. You're able to steal something, but a lot of times you want to get cash, you got to sell it. Whereas cash is just immediately available, so it's valuable to everyone, which makes it more vulnerable too. And another thing about cash is a lot of times cash, you will audit it 100%. You can usually audit it, the whole thing. And on some audits, they don't give a tolerable amount for cash. They say, no, we're going to look at everything in cash. Because one thing they can, there's bank statements. Now, unlike other assets, there's actually a third party holding on to these accounts. And so you can get all the bank statements, even for a large company. You know, for Walmart, you can get their bank statements. Maybe they have 7,000 cash accounts. You can still do it. Might take a little bit of time, but you can still do it. So whereas for Walmart, auditing the inventory 100% is absolutely impossible. There's not enough people in the world to carry that out. So one of the things about cash is a lot of times you audit 100% because they can, especially for smaller companies. You know, if they have less than, say, 10 bank accounts, easily you can audit it 100%. So we do pay a lot of attention to cash, and again, not because the account itself is so significant, but because of all the accounts that it affects. The people, you know, anyone will value cash. Anyone can readily use it, and also that we can a lot of times audit it at 100%. So for that reason, a lot of times we spend a lot more time on cash than, say, the balance would normally, you know, dictate. So cash is a really important part of the audit. Okay, now let's go to kind of the, you know, I know this is hard to read. I got to redo this one. I got to do this one more like in a vertical one. I think I got that. I think I copied the format out of a book for some reason. Okay. So here's typically how a place that collects their own checks, here's how they would do it. And by the way, I used to do this. I'll tell you about it a little bit. So someone sends a check to the ABC Corporation. Okay, the check will come into the mailroom. It's possible that the checks will get separated and go into a separate counting room. The place I was at, we didn't do that, but sometimes in the mailroom, it'll get separated and go to a separate room for counting the checks and making the list. Okay. The checks are all listed. So there'll be a list of the checks. There'll actually be two of them. The first one will go to accounts receivable because these are people paying on accounts. Where I was at, it was a bank, so they're paying on bank loans usually. But they would send in the checks and they'd be counted. Now, counting the checks, we always had, and one of the controls is to have two people at least counting the checks. Why do we do that? Why have two people counting checks making the list?
To double check the work, I don't know, make sure.
That's part of it. Certainly part of it.
Internal control.
Help prevent fraud.
Yeah. Everything you just said. And we would do that when I was at the bank. I didn't know. This was right out of high school. I didn't know what, you know, the boss told you to do it, so you do it. But you know, that is one of those things though that we had two people counting it, me and this other guy, and we would count the checks, make a list, compare them, you know, add them up, and that's what we would do. And so we'd each make our own list, check them. They'd have to balance at the end. And then that's how our two lists were made. But, you know, notice that someone in management would say, well, why do we have two people doing this? Why can't one person just do the checks? You know, this is a waste of time, money. But it's actually a very important one because, again, it is, you know, not only for the accuracy, but also it eliminates, it greatly reduces the element of fraud. So for example, let's say that you have a person A And let's say that this person is an average person and they have a 10% chance of being bad. That's pretty high, actually. But let's say that there's a 10% chance. If you had a second person, we'll call this person B. Let's say they have a 10% chance of being bad, okay? So if one person is doing it, you have a 10% chance that it's going to be a loss. If you have two people doing it, notice what has to happen. They both have to be in that 10% to being bad. You have now, reduced the chance of being bad down to 1% by having another person do it. So, and this 10% is a really high percentage, by the way. I'm just, I just threw that out there just for the example. But and not only that, a lot of times, even if I was, let's say that I was a bad person, I was in there, I still might not do it if someone else is there, because I'm not even going to try if someone else is there, right? I mean, so even though I might be, it's probably even less than 1%. My point being that, because even if I say, gee, I want to steal this money, there's this other person there, and so it greatly reduces the amount of likelihood of someone doing something fraudulent with the money. So having an extra person there is part of the controls, and it's, like I say, a management person would look at that and say, why are we having two people do the job of one person? But there's a reason for it. And because they had to make up two lists anyways, like say where I was at, I would make the one list and the other guy would make the other list, and we would compare them, and if they were off, we'd go figure out why they're off, and then we would take the checks and the list, and one list goes to accounts receivable. Where I was at, it'd be loans receivable as a bank. And then we would take the checks and the checklist down to the cashier, and the cashier would put them in with the other deposits for the day and make a deposit slip, so now we were already at a bank, but let's say this isn't a bank. Here, you're running a business and you get these checks in, and you have a cashier, usually someone who, if nothing else, someone in the office who is the designated cashier, and they get the checks and they make the deposit for the day. Now, all the checks will go in there with the deposit for the day, and they will go into the bank, and they should go intact daily. What I mean by that is the deposit every day should match up with what's in the bank. What's the deposit in the bank every day. So we can look for this 1,038 when we get our bank statement. It'll say deposit 1,038. So these are the controls that we have. Now, a couple of things that are not so obvious when we look at this. Let's zoom in a little bit. Oh, it looks even worse when I zoom in. All right. The accounts receivable person, they take care of the record keeping. They're in accounting. They take care of the record keeping. You do not want them to get the checks. We'll actually figure out why later on, but you do not want them to get the checks. Why? Because they have control over the account, and if they have control over the record keeping, and they have custody of the asset, the check, they can make both of them disappear. Someone writes a check for $600. They write the account down for $600. They take the check and put it in their pocket. Try to find that. I mean, it'd be hard. So there's also the segregation of duties. I think I talked about this before. Didn't I talk about it? Car. I think I talked about it. It comes up a lot. Oops. I should say this is segregation of duties. also known as incompatible duties. So segregation of duties, also known as incompatible duties. Custody of assets, authorization, and record keeping. So in accounting, we're in record keeping. We should not get the assets. We should never have someone hand us the checks. And this is one thing that's not obvious to people. You know, some people say, "Well, I don't know, here's a check. I don't know, hand us to the accounting people. They can figure it out." You know, but truthfully, we should not have any custody of the assets. You know, there are ways to have someone else sign off on it. For instance, in the accounting department, we have to have computers, right? That's an asset. So a lot of times what you'll have is some other department sign off on it. When we purchase computers, we have to have someone else will sign off on it. But so segregation of duties is also a big part of this. Okay, now notice what's happening here, though. You know, this check comes in. So let's go down to some of these questions down here. So if a customer needs to confirm that if an auditor, needs to confirm that a customer had submitted a check to the client, which documents would the auditor likely examine? So the auditor wants to confirm that a customer had submitted a check. Which documents do you want to look at? So customer says, I wrote, I sent that check to them already. I sent it on this date, for example. How would you find out if they sent that check? What would you look at?
The accounts receivable journal or the bank statement.
It's possible. Actually, the bank statement would not do you very much good. And I'll show you why.
It's combined with other stuff.
Exactly. The deposit's going to go in, what we call intact. So the deposit is going to have all the things in there. So if someone, let's say someone wrote the check for $178.01, you're not going to see that on the bank statement. But now you will be able to see it. Now, if it was a problem, say with accounts receivable or something like that, it's possible you would see it through the accounts payable or accounts receivable. And it should go in intact too. We'll talk about that later. But the checklist and the deposit list are probably the two most important things there that they send it in. For instance, you might be checking on something that was not credited to their account, and you say, okay, where's this check? And they say we sent it in. If you look at the checklist, it should be on there. Okay, so the checklist, probably the two most important ones you're going to look at would probably be the checklist, and then where am I? And then did something wrong. No, I'm going to do something different. I'm sorry. So probably the checklist and the deposits would probably be the two that you want to look at. No, not include accounts receivable journal. It should also be in there. That's not a bad one. The bank statement is not going to be a tremendous amount of help. And it's possible, like let's say the accounts receivable, maybe that would probably be why you would be looking into it. How did this get into that account? But either way, though, you have to look at looking at the checklist and the deposits. That would probably be the best way to see it, because we're going to remember someone in accounts receivable might be just entering writing down an account or entering something that wasn't there. So you want to see that it's on these two, checklist and deposit. Okay, how about this? You contact the customer. They said, we sent the check. We said, well, we can't find it. It's not in the deposit checklist. It's not in the deposit slip. And they said, well, I have the canceled check. I have it right in front of me. what probably happened. They sent the check in. It's not on the checklist. Think sinister.
Would it be someone else cashed it?
Probably someone took it in the, it's very likely that someone would have taken it in the accounting room.
Yeah.
Because notice, if they put the check on the checklist, you know, they hand it to the cashier, you know, if they took the check for $178, they gave us the check here, cashier said, well, where's the check for $178? You know, it's on the list, or where is it? So if it's not on the list, it's probably was done in the accounting room. And then you go see, oh, you know, where was it cashed? No, the 7-Eleven. Oh, okay. You know, 7-Eleven at 3 in the morning. Okay, well, that's, you know, so, you know, it's possibly in catch this. You know, so, I mean, if let's say if they were even if they escaped getting on, putting on the checklist, it probably means it's an accounting. That'd be a complete idiot to put on the list and then take the check. Okay. Not that not that stuff like that doesn't happen. Every now and then you get some crazy one. Oh, I just said this. This is one we just talked about. If a check was if a customer's cash check was missing and did not appear on the checklist, who said, oh, who likely so? Yeah, probably kind of employee most likely. That would have been me. It would have been me back in the day. But yeah. So anyway, they you know, these are some controls over cash. Okay. Any question on that? Okay, bonding employees. And these are done for people in financial positions. If you ever had a job as a cashier, they probably bonded you. Or a lot of places do anyways. It's an insurance policy. For losses by the bonded employee. Who embezzles cash? Embezzles? Oh. Okay, so it's usually for people who handle cash, cashiers, people who work in finance. They all get financial bonding. So it really it is in essence it is just an insurance policy. That's all it is. There's nothing special about it. It's an insurance policy for a company for losses if someone embezzles cash from them. Now, that in and of itself is probably not that big of a deal. It's, you know, they have insurance on all kinds of stuff, fire insurance and, you know, disruption insurance, all kinds of things. But the thing that makes this one different is the bonding companies will perform background checks on employees. So, and this is really the big part of it, is that the bonding company is that when a company says, okay, we're going to get these people bonded, the bonding companies will do a background search on those people and let the company know if they can't be bonded. I had a friend who worked at a place and they had this new guy that was a new hire and seemed great. They're all happy. And the bonding company came back and said, you know, you can hire him, but we're not going to bond him. He said, no, he's been in jail several times for fraud. Of course, that didn't come out during the interview. Hey, by the way, I commit a lot of fraud. But you know, and that's the beauty of it. That's the real, that's the main part about it, is that they will do the background checks. Yeah, they will, it's also an insurance policy. They'll pay up if someone does embezzle money. But at the same time, is the more important thing is that it's their job to look into employees' past and, you know, and see what, if there's anything that raises questions. So finding an employee is just an insurance policy. That's really all it is. But the background checks are really the main thing that you're paying for there. Okay, lockbox service. Oops. Customer checks. Are sent directly to the client's bank. Bank counts the checks and deposits the money directly into the account. So the money never actually, what did I ask you? And deposit the cash directly in the client. So, you know, it's sort of like, it's sort of like avoiding this. You know, avoiding this, you know, this check comes in and goes through all this stuff and then it finally gets into the bank, right? Well, they say, okay, the check's gonna go directly into the bank. Bank's gonna make a list of the checks so that we know who paid. And there isn't gonna be a deposit, so the bank is gonna directly deposit that right into our account, you know, automatically. So that's what a lockbox system is. And if you're wondering about the name of it, is because they used to have locked boxes that people would put the checks in right to the bank and say, okay, pay, you know, this company, and go in the locked box, and then they would take all the checks out and put them in, deposit them directly into the accounts of their clients. So, you know, nowadays it's a little more formal than that. They have special ones set up for everything. You know, paying any credit cards and all that kind of stuff. So a lockbox service really is just all of your customer checks going directly to the bank. The bank makes the list. The bank makes the deposit directly into your account. There's no other, you know, there's nothing else involved in it. Okay. Which of the following is true regarding a lockbox account for cash receipts?
Is it the D, the client's employee will never have access to customer's check?
Yeah, D. It's the client's employees will never have access to customers' checks. And that's part of the beauty of it, right? You know, you got all these people up here involved in it. None of that. You know, you get a list. The list goes to accounts receivable. The client's employees will never have access to the checks. Client employees will never need additional money. They're not handling the cash. There'll be a longer delay. The cash will be available. Not usually. Usually the, you know, because it's going directly to the bank, the funds are usually available faster. Now the bank obviously charges for this service, but yeah, so it does eliminate a lot of that employee handling of checks and, you know, all the problems you can have with that. So the client's employees will never have access to the customer's checks. Any question on that? Okay. Disbursement of cash. Disbursement of cash. We talk about vouchers payable. This is also true for accounts payable, which I'll talk about in a second. This is just a little bit more formal than a normal accounts payable. Okay, a vouchers payable. Here's what happens. We match up for a company whenever a company buys something, they have to have a purchase order. So the company says, we need whatever, pencils. We need these pencils. They make a purchase order for the pencils. And this purchase order is sent to an approved vendor. So the purchasing department will say, okay, we order from these people. So, they'll have a purchase order. There's usually a agreed upon price on it. Okay, we buy it from these people for this price. Here's the purchase order. And the purchase order should have the price and what the item is and how many they've ordered. So the purchase order is sent to the vendor, whoever they're buying it from. So, and by the way, this is sort of the opposite of what we just talked about, money coming in. This is money going out. Notice, it's vulnerable going out too, right? Someone could write a check to their brother-in-law or whatever. So, this is kind of the opposite side of it, but it's the same thing about getting money out of the place. Okay, we will have a receiving report. And this is when the items receiving report. This will be when the items arrive at the client's receiving area. So whatever their receiving area is a receiving report. The packages will come in. The people working there will make a receiving report of what they received from it. Usually the receiving report is a purchase order. The receiving order is usually a purchase order with the quantities blanked out. And it could be electronically blanked out, or it could be actually on a printed piece of paper that they have the quantities blanked out. Why do they blank out the quantities? So they have this receiving report. The receiving report that comes to them, so the receiving department, they get a receiving report, doesn't have any of the quantities on it. The shipment comes in. And they have to make sure that everything matches up. Why do they have the quantities blanked out? Why don't they just put the quantity? Why don't they just leave the quantities in? It's actually a control. What do you want to make sure they do in the receiving department? Leave the packages in. You want to make sure that they count them. So you have it blank because maybe you ordered 20 and maybe they sent 16. Now, if you have 20 in there, you can imagine someone like, oh, like 20, you know, they don't actually count them. So what you want to have happen is someone to actually count the stuff. So they have the quantities blanked out. Even before that, though, the receiving report, and when someone sends something in, there should be a purchase order that matches up to it. As odd as it sounds, sometimes places will just ship something without anyone ordering it and then send them a bill. And it's funny, they kind of go through sucker lists where people will figure out which companies you can do that to. So, you know, when the thing comes in, there should be a purchase order matched up to it in the receiving department. So they should say, okay, look. And I was actually, one time I was actually on a loading dock doing an audit, and this actually happened. Someone came in with a truckload of stuff, and they said, well, there's no purchase order for this. And the guy's like, well, take it away. You know, and unless you come with a purchase order, we can't take it. So it does happen. I mean, that, you know, things will get sent to, sometimes it's, you know, for bad reasons, sometimes a mistake. Someone thinks that you know, ship it to the wrong customer or something like that. But there should be a purchase order, and then you also want them to count it. So count what they give. Okay. The purchase order should also be, should be a vendor invoice. In the vendor invoice, the prices should match the purchase order, quantities, and so vendor's invoice, the prices should match the purchase order. What do they agree to for the price? The quantity should match the receiving report. The quantities may not match the purchase order. Maybe they had, you know, they shorted it. They didn't have these items or whatever. So the quantities will not always match the purchase order. In an ideal world, yeah, they should, but in the real world, a lot of times they're out of something. They didn't have, you know, like say they ordered 20, they only had 16, they sent the 16. Those kind of things happen. So while the you know, the quantities may not match the purchase order, you should still be able to be charged for the quantities that they actually sent. Question on that? Okay. So these are the three things that you match up whenever you have someone that, you know, to get a payment out. Now, you do this for accounts payable. So say, okay, well, what's a vouchers payable? A vouchers payable is simply a document that says all three of these things have been received. And it puts we cancel all those things. So we cancel the purchase order. Don't want them sending things twice. We cancel the receiving report. Again, don't want them paying for, you know, don't want them receiving things twice. And we cancel the vendor invoice. All three of those things get canceled. And the vouchers payable is created when all three documents are approved for payment. I was on an audit one time, and there was complaints about, vendor had a complaints about not getting paid, and it came up during the audit. And I come to find out that the vendor would short almost every shipment and then send an invoice for the full amount. And so it wouldn't get paid. They would tell them, send a corrected invoice. And, just kind of, one of those kind of wacky people that thinks like it's a game, but at the same time, they're not getting paid. So, I mean, at some point you'd think that it would stop, but, anyway, and they really, this was up in Mintac, Minnesota, which is a iron ore place, and there's not too much around. So I was like, that guy's pretty much the only game in town when it comes to getting some of this stuff. So, okay, lapping. Lapping is an example. Lapping can occur if the accounts receivable clerk has access to the customer's checks. And while that would be very unusual for a large company, a lot of times in small, medium-sized companies, you'll find situations like that. Who's take care of the accounts receivable? Well, Sarah does. Okay, well, give her the checks. Give Sarah the checks. She can whatever she does. So a lot of times that happens. And by the way, I say small companies and medium-sized companies. And you say, well, how about medium-sized companies? One of the weird things about medium-sized companies is a lot of times their controls don't keep up with their size. And that they expand, they get bigger, but they're still run like a mom and pop restaurant or something. So a lot of times you'll have medium-sized places that really should have better controls. Not simply because they've outgrown the controls that they've had, basically. Okay, so it occurs when our accounts receivable clerk has access to checks. What happens is accounts receivable clerk. These customers check and cashes it. It can be done in a number of ways. It can be done. And so they take the customer's check and they cash it. And so maybe they set up a bank account that has a similar name as the corporation they work at or whatever it is. But the customer, so they take a customer check. Now, there's a problem though. The problem is they're going to know about it because they're going to get a thing and say their account they owe it. So lapping is when you take other deposits from other customers and use it to cover up the theft. I'll show you in a second here. Oops. Oops. Okay, and we'll do an example down here. This is probably make more sense. Oops. Okay, so lapping. And lapping is when there's bad controls, and it usually comes about when the accounts receivable person has access to the customer's checks. Again, something they shouldn't do, they shouldn't have. Sometimes in smaller businesses, you'll have this kind of thing come up. Okay. So here we have, oh wait, let's read this here. So these are the amounts again. Okay. Accounts receivable clerk is a compulsive gambler. He steals the $5,000 check from Wilma and cashes it at the racetrack. The clerk covers the missing 5,000 with our customer's payment. How will the accounts receivable clerk conceal this crime? Okay, so here's what happened. So a normal account, Fred writes a check to the Bedrock Corporation, amount to be applied. The entire amount gets applied to the Bedrock Corporation. Okay, so that's the normal way that this would happen. Now, Wilma sends a check and she makes it pay the payee cash. This is another thing that's true about fraud, is that one of the key things is there must be an opportunity. And one of the reasons why in auditing we try to eliminate opportunities. Okay, so and part of the reason why you try to eliminate opportunities is not to tempt somebody. Okay, so Wilma sends this thing for cash. Who's this guy? He's a compulsive gambler, gets the check for 5,000. So, okay, I'm taking the check. Okay, so this is, none of it's going into Wilma's account. Takes the check, goes to the racetrack. Now, Wilma is going to find out about this. Wilma's going to get her statement back, and it's going to say that she didn't write the check. And at that point, they'll find out where the check was deposited, and they'll probably figure out who did it. All right, so accounts receivable clerk has to do something to make Wilma happy. So here's what he's going to do. He's going to take this $8,000 from Barney. Okay, Barney gave $8,000. So I'm going to take 8,000 or 5,000 of that and apply it to Wilma's account. So of that 8,000, they're going to take 5,000 and put it in the account. So this is kind of confusing looking here. Now, there's a problem with that. Now you got Barney on your back, okay? And Barney, if you send this thing out, Barney's going to say, hey, wait a minute. You only put 3,000 of mine in my account. I wrote a check for 8,000. Okay. So Barney's $8,000 check, 5,000 of it's going to Wilma. He is only going to get 3,000 as an account. So we had to make Barney happy. So how much is Barney expecting to be paid off on his account? 8,000. So how much more do we have to put in Barney's account?
5,000.
Yep. So Barney needs another 5,000. So, okay, well, here we go. Betty. So Betty deposits 6,000. So 5,000 of Betty's goes into Barney's account. Now Betty only has 1,000 going into her account. Okay, so you got to deal with Betty, but Betty put it in near the end of the month. So Betty might be thinking, okay, well, it just hasn't hit yet. Maybe Betty calls. Who does Betty talk to? That's right. The accounts receivable clerk. Oh, no, Betty, your account's fine. No, the money's there. The whole thing's there. The whole 6,000's there. Wait for it next month. If it's still missing next month, they'll let me know. But I'm looking right at your account. The money's there. Okay. So this is what lapping is when you take other accounts to apply them to, to cover up a theft. Now, if accounts receivable clerk goes to the racetrack and wins $5,000 or more and pays it back, you may never find this. You know, people, well, how often does that happen? No one knows. You wouldn't find it. Now, if you know compulsive gamblers, that's not usually the way things go, but anyway, yeah, so this is what lapping is taking money from one account and applying it to another. All right. Yeah, we'll do this question, then we'll take a break. Which of the following are ways to detect lapping? There's actually two of them that aren't too bad. Anyone?
A, compare the daily checks list total with credit to the account receivable journal.
Yeah, this would find it. You know, would find it when the nurse initially did it, because if if they had this $5,000 check was never applied on the 10th, even though they received it, they say, well, why is this $5,000 short? So that would also find it. There's one other one that's not as, it's a little bit tricky.
Well, is it the D?
D, they probably would be bonded, but notice the D is not going to find
Oh,
fraud. You know, now, should they be bonded? Yeah, they absolutely should be bonded. But it's probably not going to, this is to detect the lapping.
okay. Is it C, verify?
Yep, this one. So verify each check is entered in the accounts receivable and journal intact. And this one is actually maybe even better than the first one. They're both good, but because you'll notice something here. If someone deposits $8,000, common sense would say, okay, they want all 8,000 of that to go into their account. So if you look through the individual daily accounts that are applied to the individual accounts, you should see an 8,000. So if you match up go to the checklist, on the checks, and someone wrote a check for $8,000, you should see $8,000 applied to one account. If it's applied to more than one account, it's a possibility that this is going to be a lapping situation, that they're breaking that up into other accounts. You especially look for larger checks coming in to do that. I mean, that they would be used to pay off the other ones. So yeah, both of those would do it. Okay, I think we'll stop there. And I think when we come back, we'll do a little bit more on the Montary unit sampling. Okay, so stop here. Okay, let's say be back. What time is it? Put cats in there. All right, yeah, so be back at 7:10, and when we come back, we will start in on the where we left off on the Montary unit sampling. Oh, and by the way, I also sent out another thing, an Excel document. Looks like this. So these are the tables, but also it has blank spots here for doing the calculations for it. So hopefully that'll at least be a little easier to do on the computer. All right, so let's see. Okay, So let's go ahead and take a break and save that. Okay. So this is what we'll start up on. Did I give you guys number 3 to do as homework?
No.
No.
Yeah, you didn't. I remember.
I did or did not?
Did not.
Okay, all right. All right, well, all right, we'll do this one together. Okay, so let's go ahead and take a break. We'll be back at the 7:10. Okay, we will go ahead and something strange in my camera. So we will go ahead and start in on probably report, or I'm sorry, monetary unit sampling. And again, the reason why we're doing it this way, monetary unit sampling, in certain circumstances, it can greatly reduce the amount of testing that you do. And anyone who's done testing will tell you that a lot of times you get a classical sampling that says take 180 items. And by the time you get to item number 50, you know exactly where it's going, good or bad. You just intuitively know where it's going. And so, the question is, well, can't we do this with taking fewer items and get just as comfortable with the numbers, basically, using a smaller number? And this method actually does it in certain circumstances, not in all circumstances, but in some circumstances it'll help us. Okay, so we're at number 3 here. Now, there is this thing. And I'll try to get these both on the same page. I don't know if that's possible or not, but okay, so this table we have here, we have basically the first sheet has all the numbers for the tables. And then we have these formula sheets, and these are all the same, but for different things, we can actually do them right on the in the Excel. But I'm hoping this works better. That's my hope. Okay. So sample size, I put on total book value. Sometimes you'll see this as stated as total population size. And I'll tell you about that in a minute, why those are actually the same. But anyway, this is our formula that we used from last time. And so what we're going to do is take the numbers and plug them in here and do the calculations. Now, you don't have to use this if you want to do it by hand, that's fine too. But this is on in the Excel handout. So sample size, we need the total book value. Oh, the wrong thing here. So total book value. So population book value 2.5 million.
Are you doing number 3?
Yeah.
We
Here,
did that one last time, didn't we?
I thought I gave this to you guys for homework, didn't I?
No, we did it in class.
We did the number 2, not the 3.
I have the answers for 3. We did 2, 3.
You probably did that you probably did it on your own, because I think I only did 1. And I gave it to
We
you.
did 1 and 2.
We 1 and 2, and then I think we stopped on 3. Well, regardless, if you already have it done, then you don't need to do it.
Sorry.
No. I honestly couldn't remember if I did give it to out as a. Someone I'm going to format this. Okay, so 2.5 million times reliability factor at 0 overstatement. So I'm going to go back to this table. Reliability factor at 0 overstatements, and this is at 10%. Did it again. So 2.31. Maybe I should do it differently. Here we go. So at 10%, first row here is the row we use, and it's going to be 2.31. So I'm going to go back here. times. Divided by the tolerable misstatement, which is 60,000. The expected misstatement is 6. Times the expansion.
1.5.
So this is number 3. So I'm using these numbers, these are the ones I'm using up here. Right, I'm just plugging it. So this is the formula, and this is the same formula we used last time. But it'll be, I'm just doing it in Excel to say I think it's maybe easier to see, easier to read. If I'm wrong, by the way, if you want me to go back to the way I did it before, I'm fine doing it the other way. So I'm just taking these numbers up here and plugging them into our formula down here. Now the expansion factor, luckily when we go to the table, the expansion factor is only 1. And it's going to be I'm an idiot. That's what it's going to be. I'm an idiot. Okay, here we go. So it's 1.5 at 10%. So here's that 10%. So the expansion factor is going to be 1.5, and that is here. So if we solve for this, this will be our sample size. So I'm going to do it over here. All right, equal. So the top one equals that. I'm going to the bottom one. The bottom one, probably easiest to do that first. 6,000 times 1.5. Is that right? It is right. So 6,000 times 1.5. I can do that in my head. 9,000. These two together. So 60,000 minus. Yeah. So 60,000 minus 9,000 is 51,000. Okay, so our sample size is going to be that divided by the, oh, let's do it in the formula. With the, one 113.24. Now, if you're doing exactly the way it shows you in the book, you would round that down to 113. I would probably encourage you in real life to use 114. I'll take either one on a test, but the actual, the actual guidance on it is that you would round it to the nearest whole number. because you're going to take, these are items you're going to take for testing. It has to be a nice round number. So 113.24. So this would be, I would round it up to 114 if it was me. Just because you don't want to go into court. You basically do everything in auditing like you would want to go into court and admit something that you know. Yes, did you round it down? Yeah. Why'd you round it down? That's the way you do it. But you know, so be 114 items sample. And coming down here, you take the total book value. Oops. You divide it by items. And this will be your sampling interval. Again, if you use 113, it'll be pretty similar. Well, I'll show you what it means. So if you did it with 113, that's absolutely fine, and that is the way they show you to do it. This would be equal to that. So it'll be pretty close. So on a test, I would take either one of those. The real formula is you round it to the nearest whole number. I would probably round it up just to be safe. And even if it's not going into court, like for instance, I was doing internal auditing. You always get challenged by somebody. Nobody just says, "Oh, okay, you know, oh, we did that wrong. Okay, thanks." You know, you never get that. Where'd you get that number? How did you get that? Let me see where you got that. I don't know where you got. You know, you get all kinds of stuff. So that's kind of, so the sample size and the interval, those are intertwined in this one. So in this case, I'll see the first one here. You can take either one though. The first item that crosses $21,929.82. The first one that crosses that interval, that's when we pick. You know, whatever twice that is, 43,000, whatever. Pick that one, and so on and so forth. So whatever item crosses that interval. Now notice, if there's an item that's bigger than this, it will 100% be picked. Kind of awkward. So if there is an item that is bigger than 21,929, it is automatically going to be picked. And the beauty of this is if a customer or a client is trying to cook the books, they're trying to increase their sales, for instance. The more that they increase it, the more that they cheat, the more likely it is you're going to find it. And this is not true of classical sampling. Classical sampling, the size of it doesn't matter. Well, as far as picking the sample. But in this one, the size does matter. And the larger it goes, the more they cheat, the more likely it's going to pick. And even if they spread it out under multiple accounts, the more accounts that you spread this out over, if they're going to cheat, you know, say, okay, well, we'll just boost every account up by 10%. That makes those items 10% more likely to be picked. So this is a great method for finding overstatements. The more they overstate, the more likely it's going to get caught. Okay, so that was number 3. So this is a problem 3. Oh, hang on. What's another thing? Okay, let's go to. All right, now this is. All these great things I've been telling you about this method are too good to be true, and you're going to find out about that now. That there are some quirky things about this method. That are you gotta keep in mind. Okay, incremental allowance. In this type of sampling, the size of the error matters, and that the larger the error, the more likely the whole thing is going to be off. Right. So again, you know, large misstatements means that there could be much more off than small misstatements. Small misstatements probably mean it's off by a little bit, larger than these are off by a lot more. So when we project over it, this incremental allowance actually will expand if there are if the larger the misstatements are. If there are no misstatements, it's not a problem. But if there are misstatements, monetary unit sampling is only used for overstatements. Understatements are ignored. So if you come across an error, a problem, because it's understated, you ignore it completely. Understatements are ignored. So if the audit value is greater than the book value, you don't do anything with it. That's fine. You know, for this method, this is okay. It's kind of like fishing. You know, you're fishing for fish, and you pull in a boot. You know, well, you're not fishing for boots, so you throw the boot. Well, don't throw the boot back and throw it in the garbage. But you know, the idea is the same. Is that you know, whatever you are fishing, you know, you're only going to keep fish, and if you catch something else, you don't want. Same thing here. You're only looking for overstatements. When you find an understatement, it's not what you're looking for. You ignore it. Okay. If a misstated item has a book value that is equal to or larger than the interval, then the misstatement is the difference between the book value and the audit value. So we don't project it over. And you say, well, why don't we do it the same way we did before? And I'll show you why in a little bit here. But the reason is, when we take a sample, we always project it over. You know, we try to project it on the entire population. You know, we try to, you know, my camera's over here now. So we try to project it over the, look, it's an alligator. No, we try to project it over the entire population. So when we find one where the actual item is larger than the interval, so it's 100% it's going to get picked. For those items, we just look at see what they are, what the actual misstatement is on those. And I kind of show you why here in a minute. Okay, so let's take a look here at our items that we have, and we'll talk about the incremental allowance, and this isn't spaced right. Okay, so we have the audit value. Oops. And we have the book value. And this is sort of like we had on page 1. Okay, so what I'm going to do here is we are going to multiply these out. And this first one is pretty straightforward. This is what we looked at before. So audit over book times the interval will give us a projected value. Okay, so 114,000 divided by 20,000. Where's Mr. Calculator? Turn on calculator cam. There it is. Okay, so 14,000 divided by 20,000 equals 0.7 times 40,000. Okay, so the projected value would be 28,000. So what would the projected misstatement for this interval be? So this interval, $40,000 interval, we say that it's really only valued at 28,000. So what would be the projected misstatement? Oh, come on, somebody knows.
12,000?
Yep, 12,000. So the misstatement will be 12,000. Oops. No, I'm gonna sort this thing out. So, and forget about this incremental allowance for now. We'll talk about that in a little bit. So the projected value is 28. The projected misstatement is 12,000. I apologize for the erratic formatting here. We can bold this. Yeah, I can. Can I bold all of them? Yeah, I can. Okay. So we're going to do this for the next 1, 2, and 3 are pretty straightforward. We're going to do these are similar to what you saw before when we did page 1. And then they get wacky. $400 divided by 3,000. Okay, so this is 32,000. And the projected misstatement is 8,000. Yep. I was going to say 8. So 8,000 for the projected. And again, don't worry about this incremental allowance thing. We'll talk about that later. Here's kind of a wacky one. What's the projected value?
0? I don't know.
That's it. You do know it's 0. Yes. So it is, yeah, 0 over 7,800, so 0. Now, in some books, they will tell you that you should check and see why it's a 0, which to me is just kind of common sense. But yeah, But you know, if you look at it and it really is a zero, then it's completely overstated. And yeah, you know, if they put a fictitious account on the books, you know, you catch it. This is the, you know, this is it. So the projected value is zero, and the entire amount is misstated. And again, in a book, they'll tell you, look and see why it's a zero, but you would do that anyways. I mean, as you're going through these, it's almost humorous because you would look into it. Whenever you've had an error, you look into it and see why it is. And, you know, you already did that before you put it into the work paper. Okay, now. Number 4 is actually.
It's over by 14,000.
Yeah, but here's the thing. There's something wrong about this one. This is an understatement. And because this is an understatement, you know, because this, the audit value is greater than the book value, this method isn't supposed to find these. So in this case, the projected value is 40,000. The projected misstatement is actually not a misstatement at all. It's a zero. So this is again, this is a kooky one. This is like this is this one. Understatements are ignored. So if the audit value is bigger than the book value, audit value is bigger than the book value, we ignore it. It's fine. There's nothing wrong with that one. It's not supposed to find these. So it's ignored. So that's a little bit different, right? Usually you find an error, you go, okay, you know, and you put it down. But in this case, if it is an understatement, we ignore it. It's not supposed to find it. Okay, these last two. If the misstated item has a book value that is equal to or larger than the interval, then this statement is the difference between the book value and the audit value. And these items are not including incremental allowance, which we'll talk about in a minute. Okay. So if let's make the interval, let's give the intervals a color. Let's give them turquoise. Oops. So if the book value is greater than the interval. Now notice something about this one. For number 5, for number 5, it's 100% sure that one is going to get caught. It's the book value is 44,000. It's going to cross an interval, the $40,000 interval. It may even cross 2 intervals. It's possible it crosses 2 intervals, but it certainly will cross 1. So there's a 100% chance that that one is going to get caught. Now, that brings up a problem, though, when we actually come to projecting what the misstatement is on it. And I'll kind of show you why here in a second. Let's see. Oh, man. Okay. Did anyone actually work this out and do the division and see what it is? No. If you didn't, that's good, because you don't need to do it. But how much did you come up with?
Well, the way I did it, I mean, it did the same way. It was 10,000 for projected value and the difference 30,000. I mean,
Yeah, now, but that, let me put that in, because that is, if you were to do it the regular way, that's what you'd come up with. You would come up with it. Now, you don't need to put this in. Now, there's a problem here with doing it this way. The problem is, this item is really misstated by how much? It's got an audit value of 11,000. They have it on the books at 44,000. This is really misstated by 33,000. The projected misstatement is not really 30,000. The actual misstatement is actually higher than the projected. You go, wow, how'd that happen? It happens because you're taking the larger. It's sort of like the opposite of sampling. Sampling, you take a small amount, drift over the larger. This time you're taking the larger and then squeezing it down into the interval. So we actually go with the actual, this will be the actual misstatement for these. So whenever this is larger, you do the actual misstatement. Yeah, all right. Oops. So this will be book value of 44,000 minus the audit value of 11,000. Which means there equals a misstatement of 33,000. Okay, so the misstatement would actually, so this would actually be the misstatement, would be 33,000. And here's why. We actually know that it's off by 33,000. It's off by more than that. And this would be whatever, you probably won't need to put that in, but this would be 7,000 for that one. So this is, if it is larger than, if the book value is larger than this item has a book value that's equal to or larger than the interval, then it's just this. A book value minus the audit value equals a misstatement. It is quirky. Now, it's 100% sure it'll be picked. So they were 100% sure they were going to catch this one. Anything over $40,000, 100% chance it's going to get picked. But now when it comes to this statement, and I'll go into this in a second here, a little more detail. But yeah, so this is the misstatement. So this, at this point, you know, when you do find one that goes bigger than the interval, you stop, you say, okay, we're not going to do a ratio. Why? Because a ratio is done to project, you know, a sample over a larger interval. In this case, you know, the item you're testing is bigger than the interval. So you, and you know that this thing is misstated, actually misstated by 33,000. Okay, coming down here, same thing down here. You'll notice that this one is larger. Now, this one definitely covered more than one interval. This one may have covered 3 intervals, but definitely covered more than one. And what you're going to do is the same thing we did here. You do the actual misstatement. So the actual misstatement would be, what do we have, 90,000?
25,000?
Yeah,
And then 15,000 would be the difference? The projected value?
yeah. Well, actually, you don't, I wouldn't have to, I think these are only the, wait, I did it wrong. Hold on. I'm sorry. Oh, no, it's not. Okay. All right. Yeah, this would be over more than one interval. Now, these are only the items that were found with misstatements. So there may be many more items that didn't have misstatements. Just, you know, just kind of a quirky way I wrote this up. I'm making it worse. So these are only the ones that were misstatements. So there may have been another 100 that didn't have misstatements. Oh, wait, we can actually figure out how many there are. Ooh. The book value of accounts receivable is 800,000. The interval is 40,000. How many items were picked? Remember, the sample size determines the interval. So how many items we actually pick? Oh, somebody knows this. Take a guess. We're all friends here.
I don't know the difference, 760,000, I don't know.
Actually, you divide it. If these are $40,000 intervals, say, okay, how many intervals go into that, right? So you could actually figure out, oops, what am I doing? You actually figure out just by dividing it, you could figure out how many items. It's one too many zeros, actually. Oops, oopsie daisy. What is that, like 20? I think it's 20, right?
Yeah, it's 20.
Okay. Yeah, you can actually figure it out. But anyway, so these 20 items, these are the ones that had problems. But you know, as far as the projected value, it would have to be at least 2 of these. So this would have to be like 80. So if this misstatement was 25,000. And so this, you know, it'd be at least 80. It could be out of 120. So this would probably be like 7. It's 25. 80 minus 25 is what? Um, 55? It'd be at least 55,000. But you really don't need that one because you're actually just going to look at the misstatements. So anyway, here's what we're going to do. So we're going to look at these misstatements. So this would be the projected misstatement. All of these together. Oops. Okay, so these are all the misstatements. This one actually isn't a misstatement, but it doesn't matter, it's 0, so we can. So we add all these up. So 12 plus 8 plus 40 plus 33. I'm gonna make that a different color so it's not confusing. Right there.
Big question. How did you get the 55,000 again?
I didn't need to put that in there. I probably shouldn't have.
Oh,
The interval would have been, because the interval is 40,000 and this 90 would have covered at least two. So the interval would be either 80,000 or possibly it was three with 120,000. So this is just a guess. This is,
oh, okay. All right.
yeah. Now, if we had all 20 of these items, you could actually add up the projected value and then figure out the projected misstatement. But we can also just do it from the projected misstatement. So whatever this is, it's 60, 118,000. Is that right? I'm gonna check my number on that one. So I just added up all of. So 12 plus 80, so 12 plus 8,000, 20,000, 60,000. That's 58, right?
Yeah, that's correct.
Okay, so misstatement. So the calculated estimated for the accounts receivable would be 800,000. No, 800,000 minus. I can't see where I'm at.
Excuse me, when you add everything, I'm getting 88,000. So
Are you putting the 40,000 in?
yeah, 12,000 plus 8,000 plus 40,000 plus 33,000 plus 25,000.
I think it's more.
No, it's 118.
Yeah, I'm getting 118 too.
Oh,
Oh, yeah. So,
682.
okay. I'm getting it.
yeah, okay. Was it 682 you said? Excuse me. Yeah.
682.
Yep. Okay. Excuse me. So 682,000. Yeah, so that'd be their projected value would be that. Okay, now this would be our, so this projected value, this is our best estimate of what we think the actual balance is. This is our best estimate. So we think it's 182,000. Now, this is sampling. So it could be up by more, right? I mean, you know, you have the bell curve. And actually, in this one, it won't be a bell curve. It'll only be half of a curve. But anyway, this incremental allowance. Now we have to go into this, and this will be the last thing we do tonight. Incremental allowance says, okay, if there is a problem with an interval, it matters how big it is. You know, this is a projected misstatement at 12,000. It's possible, because this doesn't take up the entire interval, it's possible that this could be worse. Right? There could be more things wrong. It's more likely that there could be things wrong because they're wrong in that interval. And so this is projected misstatement. This could be worse. So we have what they call an incremental allowance. It says, okay, it matters how big the errors are. You know, an error of $10 is not the same as an error of $10,000. So that's what this incremental allowance is sort of doing. So if it's a normal, if it's a well-behaved item, you know, that is less than the interval, it will go into the incremental allowance. So this would be Yes for this one. I don't know. Be my first choice in color, but hey, you can see it. So incremental allowance is yes for this one. Okay, book value is less than the interval. This would be yes. Book value less than the interval. Yes, there could be more things wrong in there. This one doesn't really matter. It's not an error. So, you know, and by the way, we multiplied the misstatement by a number. So even if you accidentally said yes, it wouldn't matter. This is 0 times anything. So but I'm gonna say no. Now, when it comes to these last two, you'll notice that these intervals could not be more wrong than they already are. Why? Because this thing covers the entire interval, right? This covers the entire interval. So there's no way that this could be any worse. This 33,000 is the most that that interval could be off by. And down here, the 25,000 is the most that those two intervals could be off by. So these are also not included in incremental. Why? Because they couldn't get any worse. And we'll talk about this incremental allowance. I know it doesn't make any sense right now because we don't know done the calculations for it. But basically what we're going to do, just give you a heads up, is take these items that are misstated, and say, okay, you know, the larger the misstatement, the bigger the problem, and they multiply them out. There's a whole bunch of formulas that go along with it. But yeah, so the incremental allowance is basically those things that could be worse. These last three, well, this one's fine, so this one doesn't matter. But 5 and 6, that interval could not be any worse than it already is. This thing covers the entire interval. And number 6 covers 2 intervals. Oh, you know what? So I'm wrong. It's possible that this wasn't 20 items because that one covered 2. So we know that it had to be 19 or less items because some items might cover more than one interval. But regardless, it's you know, this is the way you're gonna lay it out though. So this will be your projected misstatement. This is your best estimate of what it's off by, but it could be off by a little bit more. And that's what we're gonna do with this incremental allowance and there's some other things here. So this is your best estimate. And it's not really a bell curve, it's more like a one-sided curve because it ignores understatements. So the understatement side of this doesn't exist. You know, so this is only for the overstatement side. What's one minute? Okay, I want to mention one more thing about this method. It's kind of a wacky method, but it reduces the amount of, a lot of times we reduce the number of samples and all this kind of stuff. Here's how this method really works. It really works like, okay, it works like this, like a blank page. Okay, no, it works like, oops, let's stop sharing. Okay. If you're wondering why this is called monetary unit sampling, it's because every monetary unit, in our case, dollars, every item, every dollar is considered an item. So if you have $50,000 in, you know, accounts receivable, that's 50,000 $1 items. So you're really picking these items, these monetary unit items. You'll also notice that the population, the number of items in the population and the book value of the population are the same thing. you know, and this last one we just did, the total book value was 800,000. We had 800,000 items in the sample. Each dollar has a equal opportunity of being picked. Now, you say, okay, well, it's interesting, but what does it mean? Notice something about this, and that is that if everything has a value of 1, what is the standard deviation? What's the variance of it? What, you know, if you have a whole string of number 1, the dollar value equals the items in the, the items in the sample. What's the standard deviation? That's right, 0. There isn't a standard deviation. They don't deviate. Everything's worth 1. So it's kind of a strange method in that it's different thinking than we normally do when we talk about, the bell curve and all that kind of stuff, and the standard deviation and how how many 1, 2, 3 standard deviations from the whatever. Well, there's some of that kind of idea in here. There actually is no standard deviation for the sample, which is kind of an unusual thing for a sampling method. But so anyway, yeah. So this is but that's why they call it monetary unit sampling. That now we use U.S. dollars. It could be in pesos. It could be in British pounds or euros or whatever. You get the idea. But it's every item in that sample, whatever makes up that total is that total book value. Each one of those is an item. So the number of items in the sample and the book value are equal. Kind of weird, huh? Okay. Ooh, this one's gonna be. I'm gonna stop there because this one's gonna be a toughie. Thank you guys. You guys want the week off? I know I do. I'll give you guys a week off. If you turned in stuff, I haven't gone through it today, so I will go through that. Well, actually, honestly, I'll probably go through it tomorrow. But if you have anything to turn in, I'll go ahead and take it. But I think we'll stop right there. I don't want to go. This method is gonna. This is gonna take a little while. This other stuff. And just save the chapter 10 cash thing for now. I wish I had more to give you guys. But anyway, any questions on any of that?
I have a question.
Yeah.
There's an assignment that it says accounting 433 chapter 1 and 2 handout due September 24. What is
it? It's one we did together. It's this one. There's not much in it, to be honest with you. And whatever you have, whatever notes you have on it. Wait,
Also, you want us to submit the notes?
Yeah. Submit whatever you have on it.
Okay.
Yeah, and again, the whole thing. Basically, everything we do gets turned in.
Okay.
So whatever you have, and that's true with and also for the sampling ones. I basically have you turn in all the handouts. Now this one was so kind of like a lot of definitions and stuff, so it's not much to it.
Okay.
Whatever you have, just turn it in.
Got it.
Oh, wait, even if it's like in our own words, it's fine.
I'm sorry?
If it's like in our own words.
Absolutely.
Okay.
In fact, it's better if it's in your own words.
All right.
There's an old saying that everything you learn, you teach yourself, and that's because you take everything and put it into your own. Yeah, absolutely. Okay, yeah, so whatever you have for chapter 1 and 2, just turn that in. And I'm going to try to make this class less definition-y and more kind of hands-on. Just, the definition stuff, when you guys take the CPA exam, you'll memorize that stuff then. There's, going over it now is not the best use of class time. So I'm going to try to just do more hands-on kind of audit stuff that quite honestly, I think is maybe more difficult than just memorizing stuff, and hopefully that makes the other stuff more meaningful. It's auditing is, it's difficult to know about it, you know, until you actually kind of do some stuff in it. So anyway, I wish I had more to give you guys this week, but next week I promise I'll just clobber you with a whole bunch of work. So you have that to look forward to. Any other questions?
Yes, sir. So I submitted my assignment for the unit sampling, the sampling unit, and then I excluded the 1 and the 2 questions, but you told me to add that one to it. So I'm going to submit it tomorrow. I just saw it.
Absolutely fine. Absolutely fine. Yeah, and you know, and here's the thing about the handouts. If you just turn the whole things in. I mean, they're, you know, I know that there's some that I give you guys work on yourself, and then there's ones that we do together. I just turn the whole things in.
Okay.
Any other questions? Okay. Well, enjoy your week. We'll let the monetary unit sampling marinate for a week, kind of wrap our minds around it, and then we'll get it again. And we'll also work on the cash one. Just to let you know, we're going to take both of those are actually kind of long, right? We're not going to finish both those next week. I can tell you that. I may just pick one to work on. I'm not sure which one, but yeah, we'll see. We'll talk about that next week. But any questions?
So I'm going to upload this video tonight.
Yeah, this video, it usually takes about an hour to convert, and then I have to edit it and then convert it again. And just so you know what, I used to come to this video like a half hour early. And the reason I don't is that adds a lot of time, you know, that adds time onto the conversion. So, but anyway, hopefully by midnight, it'll be up. I think last week, I think it was like 1 o'clock we got, you know, when it was actually posted. But hopefully it'll be quicker this time. Questions? Okay, well, enjoy your week, and I will see you guys in a week. All right. Good night.